You mentioned recently on an interview that we're getting close to the point of a financial crisis becoming bigger than the Fed. Could you unpack what you mean by that? And ultimately, is excessive Fed and government intervention in the economy and financial markets going to worsen a potential crisis up ahead?
Well, I say in terms of financial crises, I've been around long enough. I say if I wasn't there, it didn't happen. I go back to 1974 with the failure of Bank Herstatt in Germany. Early 1980s with the Argentina, Brazil, Chile, the so-called ABC banking default, insolvent banking. 1987, the Dow falls 22% in one day. Not a month or a year, one day. That would be the equivalent of let's see, about 15,000 points in one day. That's what happened. 1994, the tequila crisis. 1998, long-term capital management. Russia crisis. I negotiated the bailout. I was the lead lawyer for LTCM, opposing 140 lawyers from 14 Wall Street banks. And then the 2008 financial crisis, I was an advisor to the McCain campaign. I was on one call. It was in late August. It was after the U.S. government bailed out Fannie and Freddie. And the McCain team said, great, the crisis is over. Now we can talk about the war in Iraq, because that's what McCain wanted to talk about. And I said, John Taylor and other people were on the call. And I said, sorry, guys, the crisis is not over. You are not going to make it to election day without this thing getting much worse. You could see the dominoes falling, and everyone, at least some of us knew that Lehman was the next one to fall. I said, the crisis is not over. You need to prepare now, have a speech ready, get your guy on the steps of the Treasury with a 4-point plan. Just make up the points. It doesn't matter. American people are going to want to be reassured. I was not invited back. Then the crisis came, and McCain ran around with like a chicken with his head off. Obama didn't actually know any better, but he was smart enough to keep his mouth shut. And then McCain said, I want a meeting at the White House. And Bush said, well, if I invite McCain, I got to invite Obama because, there's an election going on. And they did. And Obama came off looking very calm and cool. Even I'm not saying he's an expert. I'm just saying he played it cool. McCain looked scary. That was the day, the Lehman Brothers weekend, and then the White House meeting. That's when the polls crossed. McCain was leading in the polls up until then. And then Obama went ahead, McCain went down and never looked back. So maybe they should listen to me in terms of winning the election. But my point is, I've been through it all. I wrote a book in 2019. I predicted the COVID crisis. That was my book, Aftermath. So what are we looking at now? What I've seen the Fed bailouts. LTCM, interestingly, the money came from Wall Street. The Fed orchestrated it, just to be clear about that. But we were like, hey, we're not a bank, we're a hedge fund. But even in 2008, Morgan Stanley and Goldman Sachs were just days away from failing. I mean, the dominoes were still falling. Lehman, yeah, but Morgan Stanley was going to be next. And the Fed turned them into bank holding companies in less than 48 hours. Now, I've done Fed applications that took 2 years because they didn't like what we were trying to do, and they just dragged their feet. Okay, this was like 2 days. Hey, boom, you're like a magic wand. Hey, you're a bank holding company, and then the Fed bailed them out. So, but as recently as 2023, we had Silicon Valley Bank. Now, what happened there? So on a Friday night, I think this was in May, I got to check the exact dates, but on a Friday night, the FDIC issued a press release and said Silicon Valley Bank is being taken over by the FDIC, and we're only paying insured deposits, which is $250,000 per person. You can have husband and wife, can have multiple accounts, whatever, but low six-figure insurance. We're only paying that. Everybody else, if your deposit is higher than that, we're going to give you a certificate, and we'll get back to you in terms of what it's worth. We got to look at the assets, figure out the bad assets, have a fire sale, whatever, get some money, do a pro rata, but we'll get back to you on that. Well, that weekend, I call it the billionaire crybabies came out in force. This guy, one of the big hedge fund guys.
Up to this point, James Rickards has explained why he believes the next financial crisis could be far more challenging than previous ones. His main argument isn't just about another market correction, it's about whether policymakers still have enough tools left to respond if a much larger crisis unfolds. If you enjoy deep analysis on the U.S. economy, financial markets, gold, and the Federal Reserve, make sure to subscribe, hit the like button, and let us know in the comments, do you believe the next financial crisis could be worse than 2008?
They're all banging on the White House saying, you don't understand, Silicon Valley go bankrupt, they're all these startups, they get $3 million at Silicon Valley Bank, that's their working capital, they can't pay the rent, they're going to have to lay people off. They ignore the fact that 95% of these firms fail anyway, with or without a financial crisis. But they basically, Bill Ackman is the name I was trying to think of. He was one of the big crybabies, but there were others. Anyway, they said to the White House, you're going to shut down Silicon Valley and all these wonderful startups if you don't do something. So they did. And so Sunday night, before the market opened the next day, the FDIC came out and said, just kidding. All the deposits are insured, unlimited amounts, no problem. And then the Treasury said, the Federal Reserve said, hey, all you banks, all you other banks, some of them, upwards of $1 trillion of assets or 900 billion or whatever, who have Treasury securities. And by the way, at this point, because interest rates have been going up and so many banks bought Treasury securities with a yield to maturity of like 1.5%, 2%, because that's where the rates have been earlier, those securities were only worth 70 cents on the dollar. Well, that's what, rates go up, prices go down. It's that simple. So the Fed said, send us your Treasury securities. We'll give you par. So it's worth 70 cents on the dollar, but we'll give you 100 cents on the dollar as a 1-year loan, and then, low interest, and then pay us back a year from now. But meanwhile, don't worry about it. So the Fed basically guaranteed every Treasury security in the system at par value, even though they were worth 70 cents on the dollar. And the FDIC guaranteed every bank deposit in the system, regardless of the deposit insurance limit, which was only $250,000. And by the way, there were some crypto exchanges that had multi-billion-dollar accounts at Silicon Valley Bank, and Cisco was not a crypto exchange, but they had that kind of amount of deposits. So I looked at that and I thought to myself, okay, Fed and Treasury and FDIC, you just guaranteed every Treasury security in the country owned by a bank, and you just guaranteed every deposit in the country, regardless of insurance. What else have you got? Meaning, your guarantees can't get any bigger than that when you guarantee all the deposits and all the treasuries. So then I said, well, what happens when the next crisis hits? What other rabbits can you pull out of the hat? And just to summarize, Jesse, yes, there have been a series of bailouts. I've seen them all going back 40, 45 years at this point, maybe longer. But each bailout is bigger than the one before. And does there come a time when the crisis is bigger than the Fed, when the Fed bailout doesn't get you anywhere because it's already been priced in and this thing is really out of control? I think we're at that point. And it's one more reason to own gold.
And what does that crisis, as it eventually arrives, mean for both Wall Street and Main Street, in your view? Are we looking at something akin to 2008? Is this going to be worse? And which asset categories do you think will suffer the most in the aftermath? And where would you see potential opportunity and perhaps picking up the pieces after a massive correction like that?
Possibly worse. And the reason I say that is because 2008 turned into a global financial crisis, but as we all recall, it started in the subprime mortgage market. There were $1 trillion of subprime and so-called all-day mortgages. And a lot of people said, well, we could have 20% losses. It's only $200 billion. What's the big deal? What they ignored was that there were $5 trillion of derivatives piled on top of the $1 trillion of junk mortgages. And that's what got, AIG Financial Products and Goldman and everyone else in pretty deep trouble. But it was huge, and we got the Treasury and the Fed involved, et cetera. But now we're seeing it in multiple dimensions. There is a global dollar shortage, and people say, how could that possibly be with all the Fed money printing? But the Fed money printing is sterilized because the Fed prints money by buying Treasury securities. So the Goldman and Morgan Stanley deliver the Treasuries to the Fed, and then the Fed gives them cash that comes out of thin air. Okay, that's money printing. But then they take the money and give it back to the Fed in the form of excess reserves. So all you're doing is inflating the balance sheet of the Fed on both sides. You're not creating money that does anything for the economy. It's not stimulus. That's nonsense. But in terms of M1 and M2, there is a severe dollar shortage. And that goes back to what we said earlier about selling gold for dollars to buy oil because you're short of oil and dollars. So that's a problem. But we have a huge crisis in private credit.
This is where the discussion becomes especially relevant for long-term investors. Instead of focusing on a single risk, Rickards highlights several pressures building at the same time, from global dollar shortages and private credit to the AI investment boom. Whether or not you agree with every prediction, understanding how these forces interact can help you think beyond the next market headline.
Now, private credit is just, old wine in new bottles, as they say. It's just the junk bond market. But instead of junk bonds and Mike Milken and, Rodeo Drive and all that stuff in the 1980s, what we have are funds that invest in loans, basically, to junk credits. We've seen some big bankruptcies at Tricolor and a couple, instead of subprime mortgages, subprime auto loans, but it's not limited to that. Massive, $100 billion and more loan portfolios to these hyperscalers and AI data center builders, et cetera. And all of that is collapsing. Now, because they're funds, you don't actually see, well, some of the borrowers have gone bankrupt, but you don't actually see the distress because it's boxed into the fund. What happens is the investors gave notice to the fund managers, who are the biggest names. It's KKR, BlackRock, Blackstone, and others, Apollo. Again, these are the biggest names in the industry, saying, "I want my money back." And the managers put up gates, and they say no. And I've written scores of private offering documents, and I've read hundreds, so I know what's in the fine print. But it starts out, here's what we do, and here's how much money we're going to make, and here's this notice periods, and how you get your money back. And somewhere around page 50 in fine print, it says, "Oh, by the way, if there's a market distress or disorderly markets in our sole discretion, we reserve the right to not give you your money back." People usually gloss over that, but it's there, and that's what they're doing. So now people are saying, "Give me my, whatever, 500 million back," and the managers are saying, "You can have 5%. Here's 2.5 million, but we're keeping the other, whatever, 9750 million, and we'll get back to you." And that's what they're doing. So now that doesn't mean it's all good on the asset side. The assets are collapsing, but nobody wants to mark in the market, because then the accountants get involved and they say, "Hey, this guy just marked this thing down. You own the same thing. You got to mark it down. Why is your value down?" And then the whole thing implodes. So right now, everyone's holding their breath, walking on eggshells, and pretending there's nothing wrong, but there's a serious problem there. And then, but I keep going, and we've got the wars we talked about, an escalation. So looking at the price of oil, the Persian Gulf, Ukraine, private credit, dollar shortage, over leverage, an AI bubble. I'm not against AI. I wrote a book about it, but I see 4 or 5 different stress points or bubbles all at the same time. Not just one. Any one of them could cause a crisis, but you combine them, you're talking about, I hate to use cliches, but the mother of all financial crises.
And so given everything we've discussed so far today, how would you approach portfolio construction in the current market environment? Would you be heavy in cash in anticipation of a large drawdown in the broad market, which would hit all sorts of other sectors as well? Do you think there's areas of the market that prevent an attractive value proposition regardless? Would love to hear your thoughts there.
Sure. I'd have 10% in gold. We don't have to revisit that. We talked about that at the beginning of the interview. So I'd have 10% in gold, not 50%, but 10% is a nice slice. I'd have 30% in cash. That's a big allocation. But people say, well, cash has a pretty low yield. Well, it's actually higher than it used to be, but that's not the point. Cash has embedded optionality, meaning you have an at-the-money call on every asset class in the world. When things collapse, you're the one who can go shopping. Instead of selling assets because you're in distress, you're the one who can go shopping for the bargain. So, and also cash Don't rule out deflation. We talked about inflation, but so cash is a very robust asset that gives you a lot of optionality. I like real estate, not downtown commercial real estate, but farms, income producing real estate, residential real estate. That'll do well. Treasury notes, I think interest rates are going to come down a lot. They may go up a little before they come down, but rather than pick an exact top, you don't need to do that. Depending on your appetite for volatility, shoot in 10-year notes, 5-year notes, 2-year notes, etc. When interest rates come down to
One of the biggest takeaways from this conversation is that preparation matters more than prediction. Diversification, liquidity, and managing risk can be just as important as finding the next winning investment. Markets are always uncertain, but having a disciplined long-term strategy can make a meaningful difference during periods of volatility.
1%, 2% level, which I expect, you're going to have really nice capital gains on those, and they're safe and liquid, assuming you're not Russia. So that's a good asset class. In terms of the stock market, I would lighten up. You don't have to get out completely. I would get out of AI. I'd get out of hyperscalers, get out of software, and some other sectors. Sectors I like, defense is going to do well, and healthcare. I look at, we all look at employment statistics, and a lot of them here are the job gains, job losses, and they break it down by category, et cetera. For job gains, healthcare is always number one. It's not technology. Technology's up there, other, manufacturing, other, service occupations, chambermaids, baristas, whatever. Some of those categories are pretty high, but healthcare is always number one. And that's for a lot of reasons, but one of them is demographics. The oldest baby boomer is turning 80 this year. Happy birthday. But the correlation between that and a whole, an 80 million people, well, it's declining now, but 80 million baby boomers approaching their 70s and going into the 80s with, sad to say, Alzheimer's, Parkinson's, dementia, heart attacks, and more. And then the healthcare providers, could be in their 30s or 40s or whatever, but they are, I can tell you from personal experience, they are so in demand. And the talented ones can get jobs in a heartbeat. So I like that sector. Oh, sorry. I should also mention energy. The Chevron's ExxonMobil. So energy, defense, healthcare. I like natural resources, mining, minerals, agriculture. I'd be out of AI, hyperscalers, software, and whatever else is associated with the bubble.